Hey everybody, welcome to our YouTube channel. Glenn Tompkins here, senior instructor on our YouTube channel. Love bringing these videos to your attention. So today's video is 5 important facts about interest rates every investor should know. Why is that important? Because it affects your ability to trade in the stock market. And that's why these facts are so important to you, to be able to understand what you can and what you cannot do, and what you want to do and what you cannot do. So let's get right into the idea here of how these things will affect your ability to make money in the stock market. One of the biggest things that rising interest rates will have an effect on is on credit cards. Because we're in trying times right now, because so much money in the market, and interest rates are rising, and inflation is such an issue, we are now turning to our credit cards to be able to buy the things that we need, whether it's gas, whether it's food, whatever it is. But rising interest rates affects your credit cards and the rate that you pay when you repay the money back to the credit cards. Why is that important? Because it takes money out of my pocket that I could be investing in the market. The annual percentage rate's currently at 18% on average, which is an all-time record. If you're using your credit cards right now, you're paying all-time highs as far as interest rates on repaying that money back. Further, nearly half of credit card holders carry credit debt from month to month, according to bank rate. How many of us were used to the idea of, I put money on my credit card, I just pay it off? It's becoming tougher to do that now, and a lot of people are paying whatever the bare minimum is to make sure you stand in good standing. Now, this story that I got from CNBC, just to give them the credit for it, but I took bits and pieces of the information because I felt that it was important that you guys understand what's going on. How about this? Credit card debt is easy to get into and hard to get out of, because we all get to that point. I'm lucky that the credit cards that I have, I've got them paid off. I've got them sitting. And you do need to use them every so often. And I do, but I try very hard to make sure that they stayed paid off until I have an emergency. And if I've got to go to those, that they are available to me. But if you're spending on your credit cards right now because you need to, that takes that out of the fray of having them in case of an emergency. If the Fed announces a 75 basis point as a hike as expected, which is happening in a couple of days, consumer with credit card debt will spend an additional $5.3 billion on interest this year alone. Folks, that's a big number, and we all fit into that, right? So it takes money out of our pocket because we're paying higher interest rates on our credit card than what we could be putting that money back into the market to invest in the market. Next fact. Mortgages. So people have homes, and have you noticed that your mortgage rates are going up, especially if you're on a variable rate? So think about that. Adjustable mortgage rates and home equity lines of credit are also pegged into the prime, but the 15-year and 30-year mortgage rates are fixed and tied to the treasury yields and to the economy. Still, anyone shopping for a new home has lost considerable purchasing power, in part because of inflation and the Fed's policy moves. You'll notice that most recently, you'll look in the news, there's a lot of people backing out of home deals right now because mortgage rates are going up. Well, that's a product of interest rates going up and how it's affecting our ability to do business. Now, if you're in a rate that's adjustable, you're getting hit with that. But if you're in a fixed rate, you're fine. For the most part, we'll see what happens. Since the coming rate hike is largely baked into mortgage rates, okay, home buyers are going to pay roughly $30,600 more. $30,000 more in interest, assuming a 30-year fixed rate on average home loan of $409,000. Folks, an extra 30, that's somebody's salary. You're paying an extra salary on top of your home loan because of interest rates. So these are facts that are affecting your ability to make money in the market by investing in the market. Next thing, auto loans. AutoZone came out with earnings today. They beat on earnings. I think forward guidance might have been down because it was down today. But this tells me that people are going to AutoZone to repair their cars, to try to keep them rather than buying a new car. But maybe you're in a situation where you need to buy a new car. Even though auto loans are fixed, Payments are getting bigger because the price of cars overall is rising. Why? Because we have chip issues, we have supply issues, driving car prices higher. Well, if the car prices are going higher, guess what? The interest on repaying the loan is going to go higher as well. You're going to shell out more money in the months ahead. Now, paying an annual percentage of 6% instead of 5%, that's a 1% move, folks, would cost consumers an extra $1,300 more in interest over a course of $40,000 in a 72-month car loan. Again, that's $1,300 more that you could have been putting into the stock market to grow your portfolio, but now it's going to a higher interest rate on a car loan. I'm thinking that a lot of people are going to be in a situation where they're going to hold off on buying a new car and they're going to try to make sure that they maintain the current car that they have. Fourth fact, student loans. For those of you who are busting your butts to pay your student loan, that's another story for another time. Private student loans may have a fixed rate or variable rate tied to the LIBOR prime or treasury bill rates. And that means as the Fed raises rates like we're going through right now, those borrowers will also pay more in interest. How much more, however, will vary with the benchmark. According to Bankrate, the average private student loans, and get this, folks, can range from 3.2% to 13.9% and 1.2 to 12.9% for variable rates. As with auto loans, they also vary widely based on your credit score. Now, think about this. If you're robbing Peter to pay Paul to make sure that you pay off your credit cards, some of your card payments may be lacking behind. That's going to affect your credit score as well. So the things that the Fed is doing, and don't get me wrong, I think that they need to do what they are doing to aggressively go after inflation. But this story is all about the facts as he does that, how it affects our ability as managing our portfolio as a business to be able to grow that business. Rising interest rates are great to go after inflation. But how does it affect me as an investor? And these are the facts that until the rubber meets the road, you may not pay attention to. But I'm trying to get you prepared so that you can take the internal inventory to see where you are, where you need to make adjustments so that you can continue to put money into your retirement. Now, as these things affect you, more or less, some people may not be able to do what they want to do as far as investing in their company or their portfolios. Unfortunately, these are the realities that stem from what the Fed is doing in raising the interest rates. The last thing, the last fact, it's going to affect your savings account. Now, normally when interest rates rise, that's a good thing for your savings account. On the upside, the interest rates on savings accounts are on the rise after consecutive rate hikes. That's a good thing. As the central bank continues raising its hike cycle, these yields will continue to rise as well. But here's the sticker. Still, any money earnings less than the rate of inflation loses purchasing power over time. So I want to make sure that I am covering my ability to do business by outpacing inflation. Inflation is so high that we're having a hard time doing it, and we're behind the 8 ball. So the Fed is trying to get us from behind the 8 ball, but by doing so, he's going to have to aggressively raise interest rates. And these are the facts that will affect your ability to run your business or your portfolio to make money in the stock market. Folks, these are just the facts. You need to take, again, that personal inventory to see where you fall in these things and be able to make sure that you can still invest in your portfolios and hopefully not lose money. Folks, this was a straightforward video getting you to understand the ramifications behind what the Fed is doing to raise the interest rates and how it's affecting our ability to make money in the stock market. Folks, I need you to like this video. I need you to share this video so other people just like you know what we're doing over here at VectorVest. Folks, we do the work, you reap the rewards. And until the next time, see ya. I want to invite you to our next upcoming big event, the Stock Market Masterclass. Folks, if you're wanting to learn how to take your investing to the next level, this is the place to be. September 30th, 2022. It's free and it can be a life-changing way for you to learn how to invest in the market and again, bump you up to the next level. Go to www.vectorvest.com/masterclass. Red